Hey, this is Kyrill Asatur, and this is Centerfin Capital's collective weekly for the week ending July 12th, 2024. As always, we like to highlight a handful of things that happened this week as it pertains to markets and investing. This week, we're going to discuss inflation. We had some updated data this week and what that means for the future. Secondly, we'll discuss the changing narrative about AI and what we think that means as well. And then last but not least, coin has had a pretty bad drawdown in the market, and it's inconsistent with the rising price of technology stocks. And so we'll discuss what's behind that as well. So starting with inflation. So we had CPI and PPI this week, consumer price index and the producer price index. CPI came in better than expected. PPI actually came in worse than expected. But what's clear is the trend is back down. So inflation, as you guys remember, started to become a real problem post the COVID stimulus in 2021, 2022. It started to come back down in 2023. It had a slight uptick in the first quarter of 2024 and has resumed its downtrend. What the Federal Reserve has been trying to do is hike interest rates in order to get inflation back down to 2%. Now, that 2% target is an arbitrary target, and we're sitting today at 3%, but as we get closer to that 2% target, that means the Fed can cut interest rates, which is why the market is so focused on it. But what's important to highlight is that inflation is a rate of change. So when we're talking about 2%, we mean that the prices of consumer goods and services are 2% higher than they were a year ago. And today we're starting at 3%. And so it doesn't mean that when we say inflation is coming down, it doesn't mean we're going to go back to the prices that we had before we had this recent bout of inflation. So we still have lost about 20 to 25% of our purchasing power since before COVID. So that inflation has done its damage. And what the only thing the Fed is trying to do is actually just bring us back down to a manageable level of inflation. Now, what we do think is important to understand is that in this post-COVID world that we're living in right now, we do think that there are some structural things that will make inflation higher than it has been and structurally higher than it has been. And those things are really big trends that we don't think are going to change anytime soon. One of which is really our fiscal situation in the United States, which we've talked about before. In response to COVID, we started running a massive fiscal deficit. We continue to run a massive fiscal deficit that's stimulative to the economy, that's inflationary to the economy. The second thing that is different than it was before COVID is that we're going through a period of deglobalization, and this was true for Trump's administration. It's been true for Biden's administration. So it's not going to change in the next administration either. But basically, what that means is that just this week, Biden announced new tariffs on steel from Mexico because that steel might be coming from China originally. That kind of policy, the protectionist policy that comes from a deglobalization mindset, is inflationary because it raises the price of goods to the consumer at the end of the day. And so we don't think that any of that is going to change anytime soon. And so we think we're stuck in this structurally higher inflation regime for the foreseeable future. What it also means is that we're likely stuck with a structurally higher interest rate regime for the foreseeable future. The dreams of going back to zero interest rates that we had post-financial crisis are not going to happen. Inflation's coming down, Fed will cut rates, but we're probably stuck in a more permanent, structurally higher inflation, structurally higher interest rate regime going forward. And it's just something to be aware of because this needs to be part of everybody's thinking as they're managing their own finances, managing their life, and thinking about how they're investing. Secondly, we would want to talk about the latest kind of change in the AI narrative. AI has been, as you guys are aware, a super hot topic to talk about. These generative AI models that came on the scene about 18 months ago are anything they're everything that anybody's talking about right now. And recently we saw some press, including some papers that Goldman put out, that are questioning all the spending that we're doing on AI. So the number that's estimated is something around $1 trillion will be spent and has been spent and will be spent in the next couple of years for the use of this technology. And the question is, this $1 trillion, is there going to be a return on that investment with this technology? Is this technology actually going to do anything? And it's a good question. It's a skeptical view on this technology and whether or not spending all this money is actually going to benefit the companies that are doing the spending. And what it reminds us of is a couple of different things. It reminds us of a quote from Bill Gates, who said, "We overestimate what we can do in a year, but we underestimate what we can do in a decade." This technology is relatively new. This came out, call it 18 to 20 months ago at this point. So it is something that is yet to be broadly adopted. And I think we probably do overestimate in the short term how much this technology can really change things. However, we are users of this technology and we can see the potential benefits as its adoption gets broader and broader. And we think it will be powerful and it will change things and it will increase productivity across many different industries and across many different jobs. And so it just might take longer than people expect. And so we're spending all this money right now because there are very few companies, NVIDIA in particular, that can make the chips that can make this technology run. However, in the long term, we think as more capacity comes online, the price of the chips will go down. The price of compute, which you're going to start to hear about a lot more, the price of compute is very expensive right now. That's going to come down and the technology will get broader utilization. And we think it will be hugely productive for companies and for society and for the economy. And in any new technology, when something new comes out, we tend to get very excited about it. And there's overspend during the internet bubble. If you guys remember that, the internet was going to change everything, and it did. But initially we built too many pipes for it. So the telecom company spent way too much building out the pipes for the internet, and it didn't get used for another decade. And so we might be experiencing the same kind of pattern here. So long story short, it's good to be skeptical of this technology, but we do think longer term, it's going to be hugely beneficial to businesses across different industries and across different job roles. Last but not least, if you follow crypto, Bitcoin is down probably 20 to 30% off its recent highs back in the first quarter or second quarter, early second quarter of this year. And it's inconsistent with the NASDAQ. So Bitcoin has been correlated with the NASDAQ, which is the technology stock index. And the NASDAQ is making all-time highs. And so what's behind the price move? It's nothing crazy or nefarious and nothing has really changed, but what's been happening behind the scenes, which unless you're deep into crypto, you're probably not aware of, but one of the original exchanges for Bitcoin, Mt. Gox, which was a Japanese exchange, went bankrupt in 2013 or 2014. And it had about 200,000 Bitcoins when it went bankrupt. And it's been effectively in receivership by various governments throughout the world as they've been working out how to distribute those assets. And this week, it was rumored that Germany, which holds something like 10,000 of the Bitcoins, was starting to distribute those Bitcoins to the stakeholders that they're due to receive them. And that extra selling pressure or the anticipated selling pressure is probably what has put pressure on the price of Bitcoin. And so that selling pressure will abate at some point, but we just thought it would be interesting to highlight because it wasn't clear in the beginning when the sell-off started a couple of weeks ago why this was happening, but it seems like it's just selling pressure from the original Mt. Gox liquidation, which started a decade ago. So that's all we had for you guys this week. As always, let us know if there are topics or questions you want us to cover in our next weekly, and have a great weekend.